Hi, my name is Kevin Blanche. Today we're going to talk about how the insurance company gets so fat, why they're such a massive animal that they are. I'll break it down into rosy terms. Elementary school teachers can use this, junior high school teachers, high school, college. It's the same basic format for anybody. And we're going to break this down to very common ground where anybody can understand this. Okay. First off, we're going to start about the insurance industry as a whole. Now we're going to get into time value money, your money. Okay, the insurance industry as a whole, you turn 16, 17, 18, we'll take 18 as our starting point. Okay, get a car, you have to buy insurance, mandated by law. Okay, so let's start off, and we're going to talk about how much money over a time span the average American spends on insurance. How much of it the average American gets back, and how it's swollen this industry into the massive, incredible animal that it is. Okay, first off, auto. We're going to get into home. Okay, health. Okay, business, if you have a business. Now, if you have a business, my business, I pay 19% of my workman's compensation fund of matching employee wages, which is ridiculously high, but it's a dangerous field that I'm in. Okay, so in business you pay workman's comp on your employees. You've got to have liability. And then all the other insurances that come along. We could talk about life insurance, as I call it, death insurance. What a horrible investment, but that's a whole other issue. Okay, but we're going to talk about time value money and put this into context how much this animal really is. Okay, so we all understand that there's a whole bunch of different insurances and we're paying a lot of money. So we're going to say, okay, auto, average in America, we'll say $100 a month. Okay, which is very conservative. Okay, we'll say home. Granted, I know you don't own a home, but we'll take an average here. Average homeowner insurance policy, $2,400. And I know for a fact these are conservatives because I know what the numbers are. Okay, health. We're doing this per person. Okay. Health is probably somewhere around $5,000. Okay. Business. Excuse me. Now this is sorry about this. This should be 1,200 per year, because we're doing an annualized. We're doing this on annualized. Okay, so 5,000, 2,400, 1,200, and then we'll go miscellaneous. So we got 7,400, we got 8,600. We're going to round it off to $10,000 to make this simple and easy, which is an extremely conservative number. Okay, like I said, I know what the numbers are. All right, we're going to talk about time value of money, which is a very simple equation for all you finance 101 guys. And we have present value, which will be 0. Okay, your payments. So again, we're doing it on an annualized basis of 10,000. Okay, of course, then your interest rate. Now, a person like me, I'm 50, so I've been paying for 30 years. The interest rate now, we'd have it around 3%. Pathetically low, but historically over my time period, there was times, believe it or not, when the rate of return you could expect on a passbook account or an investment, the average in this country was 7%. I know it's hard to believe. There are times it was even much higher than that because we've had this falsely stimulated, ridiculous interest rate. But just for argument's sake, we'll call it average over a 30-year period of 5%. Okay, so we got our present value, 0. Our payments, 10,000. Okay, how many periods? Annually. We're doing this annually. Well, let's go 30, which we all know, if we live a full life, it's going to be more like 60. But we'll use 30 just for, say, and we'll use 5% because believe it or not, this interest rate isn't going to say 2-3% forever. I don't think. Let's hope not. Or we're going to be paying $10 million each per house. Okay, so we put that into time value money, into a calculation. Okay, now you're all sitting here, $10,000 a year over a 30-year period would be $300,000. Okay, even with the low interest rate, compounded, because money compounds, we turn into somewhere in the neighborhood of $750,000. Now I'm rounding these up. I don't have a calculator right here in front of me. And if we get into a situation where in reality you're paying for 50 years, which is more reality, that number will give you heart failure. So let's just say, for sake, that the average person, time value money, what that money would be worth was put in the bank account. Now granted, you're not just going to go put it on the bank account, but maybe you are. And so that's the number I'm going to use. We'll go conservative. If that money was put into account, let grown, easily $1 million. We'll go $750,000 over a 30-year period per lifetime. And in reality, you're not just paying 30 years. If you live a whole life, you're paying 60 because it never ends. You know, if you live to be 80, you started at 16, really, but we're 20. And granted, I know you don't all home, but eventually you will. And so these are why these are averages. And I know this number's conservative because I know what the hard number is. All right, so you have $750,000. Now let's get into why the insurance company's so fat. In theory, insurance companies will tell you that is not their money. That is their policyholders' money. Okay, we're talking per person. There's 308 million people in this country. Okay, take the averages. Say if even half the people are paying that, I mean, you could do the math, staggering stuff. Well, in the 1980s, early about 1980, the average kick-out rate by an insurance company was somewhere north of 90%. So all this money that was taken in, in theory, they needed this insurance big pool so they could kick it out. Well, over the last 30 years, the kick-out rate has gotten lower and lower and lower. And the insurance companies want to hide this. They want to hide it big time. The number has gotten low, 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 to where there are estimates out there. And the insurance company's not going to tell you. They'll fight with me like this on cats and dogs. They're full of shit. Their kick-out rate is as low as 2%. Look, you put all that money in, nobody ever gets any of it out. Go file a claim. They'll fight you tooth and nail. They play time value money. They'll wait you out in court, hope you die. So a 2% kick-out rate. The only people that get any money is this jackpot justice we have. You might get lucky. Oh God, this guy got $6 million you hear on the news. But the average American gets 0.0 of all they put in there. Now you're going to say, well, you can draw the same numbers with a mortgage. You got a 30-year mortgage that you're paying $1,000 a month for 30 years. But here's the difference. At the end, someday that mortgage ends. You don't pay a mortgage forever. And when it ends and it's over, you own the asset. I seen an interview on Good Morning America years ago, and I think it was CEO of Travelers. This is many years ago. And this was brought up to him. He says, look, you guys are sitting on trillions of dollars. What are you doing with all that money? And they're like, oh, it's the policyholders' money. And this reporter went after him. Says, your kick-out rate's getting lower and lower and lower and lower. And this was 10 years ago. That money doesn't get kicked out. You guys, even at this low interest rate, you guys are making money on that. I mean, what do you think they do? Just let that money sit in a vault? They got that money working out there. So that's how the insurance company got so massive, so incredible. And they've got governments, state legislatures. In our state, for instance, the state is just chock full of insurance underwriters, agents. They're just agents. They don't own the insurance companies. So the insurance company hires these agents. They get a piece of it. They have very, very little overhead. Very little overhead. Kick-out rate. So this has ballooned into one massive monster. Now you know why when somebody tries to regulate this industry, they can attack it from all angles. You don't think they have the money? They have the money. This is a good teaching tool. I also use the same tool when I teach entry-level finance students. I tell them, okay, we use in this context of an automobile. And we say, okay, if you put away your car for 4 years while you're going to college from 18 to 22, because a lot of people, young people have cars and they drive. Not all. You know, and I have my students break it down, time value money. It's how I introduced them to the time value money calculation. Einstein said it was, you know, compounding was the greatest power on earth. And so I break that down, and so it ends up, make a long story short, it ends up being about $40,000. Thanks.